Joining us is the CIO of PIMCO's Core Strategies, Mohit Mittal. Mohit, great to see you. Firstly, what are you expecting in terms of rate cuts by year end?
Thank you for having me. Yeah, I think with respect to the rate cuts, I think if we look at kind of the incoming data, what we observe is that an economy that is transitioning in nominal terms from a post-pandemic sugar rush to a pre-pandemic trend growth. And in that environment, I think at starting rates of 5.5%, are high for a U.S. economy. So in that environment, we see a Fed that is cutting rates at a modest pace, and I think that would be prudent. I think the risk would be that if there's an aggressive pace of rate cuts, what that would mean is that the balance of risk on inflation could shift to the upside, and in that environment, Fed would have to shift course and reverse course. So prudent policy path as far as rate scenario for the Fed is a moderate pace of rate cuts from now to the year end.
We touched with Mike just there on where the 10-year sits at the moment. Do you want to be short duration or long at the moment? Is 3.7%, 3.8% enough of a reward for 10 years?
I think if we look at it in a little bit of a longer horizon, if we kind of take a step back from the next 1 to 3 months and look at it in a little bit of a longer horizon, there is a lot of value in high quality fixed income. I think that value stems from, first is the starting yields. High quality fixed income offers yields to the tune of 5.5% to 6%, and investors can get that with a high degree of comfort over the next 1 to 3 years. Additionally, there's a lot of value in fixed income from an inverse correlation versus risk assets point of view. We saw that in the beginning of this month when equities had a 5 to 6% decline, fixed income returned 4 to 5% positive. So that inverse correlation properties of fixed income make it attractive for investors. With that said, in the very near term, the rates have rallied. Our thinking is that the market is pricing a little bit higher rate cuts in the very near term, and you could see central bank delivering rate cuts that are a little bit below than what is currently priced in. But on a longer term basis, fixed income looks quite attractive.
Fixed income looks attractive. Mohit, if we just zoom out a second, your thoughts on the consumer. We're seeing mixed signals right now with retail sales holding up better than expected, but then the reports from Walmart and Target suggesting that the consumer is just continuing to hunt for value.
Yeah, absolutely. I think you covered it right. I think there are lots of mixed reports. But if we take a step back from any single incoming data point and think of it in an aggregate terms across consumer, across corporates, across bank earnings, what we observe is an economy that is shifting from a kind of a post-pandemic sugar rush to what is a trend growth for an economy like the U.S., which is closer to 1.5% to 2% real, inflation in the 2-point-something% range. And that's where we think over the next 1 to 2 years we would settle. And in that environment, central bank can deliver a modest pace of rate cuts. Certainly, there are risk scenarios whereby growth comes out below central bank's expectations, or you have geopolitical related risk scenarios. And in that environment, growth could come out lower. But in a likely path, we think more like a 1.5% to 2% real growth with an inflation in the 2-point-something% range over the next 12 to 18 months.
What's your view, Mohit, on the US dollar from here? Obviously, it's softened of late. Is it down just to simple interest rate expectations with the more dovish tone coming out of the Fed, or is it something more structural and lasting than that?
Yeah, I think the near-term interest rate differentials have played a role in the weakness of the dollar over the last few weeks. I think over the longer term, when we look at it, I think we do find value in some non-dollar or some emerging market currencies where you have high starting carry, high starting yields, and valuations do look attractive. For example, like Mexico, Brazil, Indian currency as well. So those would be good currencies to have in a portfolio context. I think in a scenario where the Fed is cutting rates at a modest pace, those currencies would do well. In a scenario where growth was to weaken further, certainly dollar acts as a risk-off hedge, as a flight to safety. Dollar can do well alongside other currencies like Japanese yen.